Hi, Mr. and Mrs. Kessler, John and Mary. Thank you for hopping on this call with me today. I appreciate the opportunity to take a look at your financial picture and help you with this. It was actually a lot of fun. Like, spreadsheets are my happy place, so I had a lot of fun working on this. And I think that we have some good plans to move forward with. So, first, I just want to kind of recap what we were looking at and some of the information that you gave me to make sure that I'm working with accurate information. So you've got a copy for each of you of your kind of proposed financial plan here. So you can work through that with me. And then I know that you had some questions that we'll also talk about today. I did a little bit of research based on what you had asked the last time that we met. So I've got some answers for you. And we'll go through that. This is going to be a lot of information. Will probably be, I'd say, 40 minutes to go through it all. What I don't want is for you to feel overwhelmed by it. There's a reason that I do what I do, and I kind of take this big picture and break it down into small chunks. And then from there, we just kind of, it's like, how do you eat an elephant? One bite at a time. We just take one little piece at a time. So I'll be giving you a lot of information, and we're going to be talking about several different things as we go through this, but feel confident that at the end, we have just four areas that we're going to focus on first, just kind of four action items that will get us started. And as we go through this process, I think I mentioned before, I like to call it a stair-step financial planning process. So first we start with your retirement income, and we make sure that while you are both on this earth and you're in retirement, that you have the income that you need coming in, and that we have kind of maximized the income available to you, and we've minimized your taxes. Once we get that income plan in place, that tells me what kind of tax planning do we need to do. So that tells me when you're both 73 and you have to start taking distributions, is that going to affect you and how much? Kind of some of the what if scenarios that we had talked about with possibly selling machinery in your installment sale. How much does that affect you and what can we do? So after we get through tax planning, then we move on to estate planning. And that is, again, while you're both on this earth, how do we set up your estate financially to, again, mitigate taxes and to take advantage of as many estate planning techniques that we can to keep your estate under the thresholds for estate taxes, so that when you both leave this earth, your legacy plan is in effect. And that passes on the assets that you want to the charities or to the people that you want them to go to. Again, with as little tax possible and also as efficiently as possible. So if we take it one step at a time, that's kind of what we're going to go through today. So these are kind of the assumptions that I'm working with. You are both retired. John, you just retired this year, and you had about $12,000 of earned income at the very beginning of the year. You sold your business. You got a sizable, about $800,000 deposit up front, and then you are getting around $47,000 a month each month for the next 7 years on the first of the month. Mary, you retired last year. You've got a pension. You're receiving your Social Security. John, you're drawing your Social Security. And when we looked at your expenses, you both needed around $575,000 a year, and $285,000 of that is just to pay your taxes, because you're in about the highest marginal tax bracket of 44% right now with state and federal combined. So the reason that you came to me was to create a comprehensive financial plan that will help you meet your goals financially and also help you just improve your financial situation. So the purpose for this is doing just that. So we're going to go through a few areas. First, we're going to look at overall financial health. Then we're going to look at risk management. That's a fancy word for insurance, basically. We're going to check your insurance coverage, make sure that you have everything in place that you need to be in place, and that it's set up the way that protects you in the event that something happens or a claim arises. Then we look at your investments. So your stock account, your mutual fund account, and your retirement accounts. We look at your investments and make sure that those are allocated the way that you want. We look at your retirement planning, which you're in retirement. So actually, your retirement plan is going strong right now. Then we look at tax planning. And again, we go over, can we mitigate your taxes? And if so, what are some of the strategies we can use to do that? And then we look at your estate and legacy planning to make sure that what you have is set up the best way possible for while you're both alive, that it's set up for when the first of you passes away for the survivor left behind, and then that it's set up eventually for when you both pass away and your legacy plan takes effect. So when we met last time, you went through a goal setting worksheet. And in that goal setting worksheet, we listed your goals and then we prioritized 1 through 4. We came up with kind of 4 top goals that we want to tackle right now in order of priority. 1 was to reduce your estate and gift tax liability, ensure your estate planning documents are in order. Your second goal was to review your insurance contracts and discuss the implications possibly of purchasing a long-term care policy. Third was to reduce your personal income taxes if possible. And fourth was to recommend a diversified portfolio that meets your risk tolerance, your needs, and your expectations. And when we were going through that, when I look at, I'm just going to start with kind of that investment piece of it and the assumptions that I make when I'm doing the planning. So correct me if I'm off base on any of these. So I also want to kind of reiterate where we're at and make sure that I'm working with the best information, most current information. So right now, you're both retired. You're in the spending phase of your life cycle. So all of the work that you did your whole lives, the 40 years of work and saving and missing kids' baseball games to put in the extra hours, you are reaping the benefits of that now. And you're comfortable in retirement. When I assess your financial situation, your current ratios, so your assets to your current liabilities is very good. Really, the only current liability you have right now is a small amount of credit card debt that's going to be paid off from your vacation and what's left on the mortgage of your vacation home, which is at a good interest rate, and you've only got 39 payments remaining, so less than 4 years. In today's environment, I think that's really good, especially with the low interest rate on the vacation home, because that interest rate isn't available at this moment anymore anyway. So we're looking at your goal for what you've saved to produce the income that you need each year, and also to preserve as much capital as we can, because you've saved for these 40 years. Now we don't want to spend any more than we absolutely have to on taxes, and to keep what's in there for you to live on for your lifetime and then to be passed on to your kids. You both have expressed when we did the risk tolerance questionnaire that you're really comfortable with taking investment risks. So I would consider you above average on your willingness to take risk. And also based on the financial situation that you're in, I think you have above average ability as well. You have experience using mutual funds. You have a mutual fund portfolio. You have a stock portfolio. So you have experience in both of those. So now I take what you've saved, and we know that we need to spend some of it. And we also know that we need to tax plan with some of it, and that we want to get the investment strategy allocated back to where you would like it to be. Now I look at, okay, this is what we have to work with. How long do we need to work with this? So when I look at your ages, I'm going to plan out for the next 30 years. I like to take clients out to age 100. So the first stage that I'm looking at while I'm planning is that 30-year horizon in retirement. After that, the second stage will be to disperse the remaining assets that are left to your kids. The one liquidity, so the one kind of major purchase that you mentioned you had coming up was a new car that might be around $40,000 after you trade in your old one. Is that still accurate? Okay. So I don't know of any legal or regulatory issues. You should review your wills, and we're going to go over that when we talk about the estate planning section. The one concern that I see is taxes, because a bulk of the income generated by your portfolios will be taxed as ordinary income due to that installment receivable note mostly. While you still have that installment sale monthly payment coming in, that's going to push you into higher tax bracket thresholds It's going to subject you to additional tax on your investment income with the net investment income tax. NIIT is the kind of acronym for it. And it's also going to make your Medicare premiums higher because you're going to pay an additional amount on your Medicare premiums while your joint income is above that threshold. So taxes are incorporated into the spending budget right now, and I have those incorporated into all of my planning. So when we go through the rest of this plan, I'm already incorporating the funds needed to pay taxes in the planning. Also, you mentioned last time that since you both lost parents to lung cancer, you would prefer to not invest in tobacco-related companies. So I've also taken that into account when I go through the recommendations that we talk about. A couple more assumptions I'm going to look at. Time horizon in retirement, I take you out to 100 years old. I'm assuming an inflation average rate of 2.75%. Of course, inflation goes up and down year by year, but when we just average it out, I'm going to go with 2.75% inflation. Because your Social Security increases directly correspond to the inflation rate for the year, I also have your Social Security increase projected 2.75% each year. I'm assuming your marginal tax bracket is going to remain pretty high throughout retirement if we follow the current plan the way it is right now. As we implement recommendations, hopefully we start to get that tax bracket down. I'm assuming that any distributions taken from your retirement accounts will be fully taxed. When I look at income planning and investment planning and projections, I'm only using an average 5% growth rate. That does not mean that I expect you to average 5%, but I feel like 5% is pretty conservative, and I would rather under project growth so that just in case we have that fluctuation, the up year, the down year, I would rather take a more conservative approach when I'm planning for income that's going to be needed and things like that. So I have a few documents that I'm going to go through kind of as we go through each piece of this plan. First off, when I went through, and if you look at your executive summary here, this is just kind of a overview of your financial situation, the strengths identified, and just some of the core components that we'll address later. Your current financial situation, you've got a net worth of about $13.7 million. Your net disposable income for the past year was about $1.6 million. A big chunk of that was $800,000 from the deposit on the installment receivable. Together, you have sizable net worth. You have adequate disposable income to meet your needs. We calculated financial ratios that kind of tell us your strength. They give us benchmarks to work against. Your financial ratios far exceeded the benchmarks. Your assets to liabilities, much higher than the benchmark of 1. Current housing debt, you only have the small mortgage left on the vacation home. So again, you far exceed any benchmarks. There's no concern there. The one thing that I looked at is I like to make sure that clients have an emergency fund set aside. So, if something happens and you need to access a significant amount of funds, I like to see 3 to 6 months worth of living expenses set aside. So for you, that would be around $300,000 if we go with 6 months worth of living expenses set aside that you can access immediately. So not tied up in investments, not in the stock market, not something that we take a chance on if the market is down, pulling out a big chunk of cash while the market is down, because then we lock in losses. We don't want to do that. When I looked at what you have in the bank, you have $746,000 total, but a little less than $150,000 of that is in actual checking or savings account. You've got $600,000 in CDs, which is a good idea because it's a good chunk of money and you don't want it to sit earning very little like it would in a traditional checking account. But I also want to make sure that the CDs are set up so that if you need to access cash, you have the ability to do that without taking too many penalties. So $600,000 in one CD that might mature in a year might not be the best idea. But if we take shorter duration CDs and break them up, or if we take that $600,000 and maybe invest it in a money market fund, That way, if something happens and you need to pull $100,000 out next week, we could take it out of one smaller CD and just take the penalty on that smaller CD versus having all $600,000 in one chunk of CD. So that would be something that I would address. I don't think that it's an emergency situation, but as those CDs mature, if you reach out to me as they come to mature, let's put a plan together to make sure that we get them set up in either a good CD ladder or we get another $150,000 set up in maybe a money market account and leave $450,000 in longer duration CDs if you're getting a better interest rate on those. But again, as they mature, just reach out to me and let me know, and we'll take a look at what's maturing and what options we have with those. So going through the analysis and your goals and your prioritized goals, there's 4 specific areas that will have the most immediate impact that we'll work on to begin with. And those also align with your prioritized goals. Rest assured, as we go through this process, we monitor, we help you stay on track. So if you turn the page, we're going into your, oh, I'm sorry, you had some questions. Yeah, so you had considered looking at 529 plans for the grandkids, which is always a good idea, I think. So 529 plans, there are several ways that you can save for college. In your case, with your high net worth, I think 529 plans are probably the best because they have the least restrictions for what you can contribute based on your income. With 529 plans, you can set these up for anybody. Doesn't have to be a child or a grandchild. But assuming here we set them up for each grandchild, these are specific college accounts. If we contribute to a 529 plan that's offered by your state, many times they offer tax deduction within your state. It doesn't help you on your federal taxes, but it could help you on your state taxes. What you put into the 529 plan is limited only by the amount of the gifting limits each year. So you each, and this is just a federal law, you can contribute up to $19,000 per recipient each year for each of you without having to pay a gift tax on it in that year. So, or without having to file a gift tax return, I guess I should say. So they also give you the ability to gift split because you're a married couple. So let's take $19,000 for John, $19,000 for Mary. Put that together, we now have $38,000 that you jointly can contribute to each recipient. Each of the grandkids is your recipient, so that's 3 recipients. So if you each can contribute $38,000 to each kid times 3, that's what you can contribute per year without getting yourself into a situation where you would have to pay gift tax on it later. However, 529 plans specifically allow you to fast forward and take 5 years of contributions and do them all in 1 year. If we do that, you cannot gift anything else for the next 4 years. So, for instance, you want to buy your grandson turned 16. How old are your grandkids? Are they old enough to be 16 yet? So you have a grandkid that's turning 16. You want to buy him a vehicle. You won't be able to do something like that if it would be considered a gift for the next, after this year, 4 more years, because we're already maximizing now our gift limitations for the 5 years in this 1 year. But together, that gives you the ability for just this year. Sorry, I have a screen up here that I'm looking at to check my numbers. That gives you the ability to put in $570,000 for this year. And again, if your state allows it, and we can research some 529 plans, you might potentially be able to take a state tax deduction for that. So that's $95,000 between the two of you. Your $38,000, you can contribute up to $95,000 per grandchild per person. Let me do my math again. Sorry. 95,000 times 2, that's $190,000 per grandchild that you can contribute. So for 3 grandkids, that puts you at $570,000. So that's an option, and we can discuss that. If we do that, there's an additional tax form that needs to be filed. I would also run this by your CPA because as I can look at tax advice from a financial perspective, but I'm not a CPA. So I would always suggest anything that will affect your taxes that we go through in this plan, let's run it by the CPA as well. And if you give me permission, I am happy to talk to whoever does your taxes directly on your behalf. So another option with the 529, well, one con of the 529 plans is that if your grandchild doesn't use it for higher education, say they get scholarships and they don't need it, or they take enough AP classes in high school that maybe they only need 3 years of college and there's money left in the account, they have options with those funds, because what you put into those funds grows tax deferred. And as long as it's used for college, then they take those tax deductions off of it. So it's a good tax advantaged college savings account. But say they don't use all the money in the account and they don't need any more schooling, what are they going to do with the funds that are left there? They can either transfer it to one of their siblings. So if one of their siblings runs out of funds and they're going to med school or something and they need more, they can transfer it from one sibling to the next. Or if you prefer that they say each kid gets this amount and it's theirs regardless if they use it or not, they have a couple options if they don't use it for school without getting tax implications for having to, because if they take it out and they don't use it for school, they pay ordinary income tax on what they take out and a 10% penalty on any gains that were made and any gains that they had in the account. So if they don't use all the funds, couple options, they can either roll it into a Roth IRA, and there's age and investment limits. They'll meet the investment limits most likely based on what would be left in there. The age limits vary. So assuming they meet the age limits, they can contribute or they can roll it over from the 529 plan to a Roth IRA in their name. And then they get, again, tax deferred benefits. And once you have a Roth IRA, it's got to sit there for 5 years. But after 5 years, say they just leave it sit forever and they go to retire, it's all tax-free. So all of that growth, everything is tax-free. So having to use the 529 for education might be a bit of a con, but they do have good options, whether they transfer it to another sibling or just leave it for themselves and roll it over into a Roth at some point in their life. Either way works. So that's a good option. And we can look at that more if you'd like to. So moving on, any questions on that? Okay, so moving on, the risk management or the insurance review, basically. So I looked at what you've got in place for your property and casualty insurance as well as your health and life insurance. So let's start with the property and casualty insurance. Your homeowner's policy, so the way that homeowners policies work is the insurance company looks at the replacement cost of your home. So not the land it sits on, but your home that's sitting on the land. And this might be different than fair market value. So I'm going to assume that it's the same as the fair market value, but your insurance agent probably knows a little bit better how insurance companies are treating, like the year that lumber was crazy expensive, replacement costs were higher than the fair market value cost for insurance purposes. So right now your primary residence has a fair market value of $775,000. If I look at 80% of that, that's $620,000. Your current homeowner's policy only has a face value of $400,000. So if I do a hypothetical claim of $100,000 loss on that home, your insurance policy takes a ratio of, I'm going to check my numbers here on this other screen. They take a ratio. So your adequate coverage amount of 80%, and they apply that ratio to the loss. So if you had a $100,000 loss because you don't have that 80% threshold met for the fair market value, you will have to pay your deductible plus the shortfall amount because you were underinsured. So a $100,000 loss, you're going to be out of pocket almost $36,000. I would recommend working with your insurance agent to increase that primary residence homeowners coverage up to $620,000. So you meet the 80% threshold. You have low deductibles on your policies. You could consider increasing your deductibles, That would help offset some of the additional premium. The vacation home actually has a little bit high. It's about $20,000 over. The vacation home, you only need $440,000 to meet that 80% threshold, and you've got $460,000. If it were me, I would just leave it as is. I mean, a $20,000 difference doesn't make that much of a difference in your premiums, and the home's going to appreciate. So I would leave it as is, but you could drop it down to just the $440,000 that you need for the 80%, and that would also help. Again, your deductible on the vacation home policy is also pretty low, so I would say you could also increase the deductible, and even up to $1,500 or $2,000 deductible, and that would help reduce some of the premiums. Your auto policy looks adequate. I did kind of a hypothetical $14,000 claim on the auto policy. You have a low deductible, so your auto policy would pay $13,500 on that. Again, you can also consider increasing that deductible, and that would help offset some of the additional premium that you pay on the homeowner's policy. I noticed two pieces that I would recommend getting in place immediately. You mentioned that you have a boat, and I think the value of that boat was, let me look up here, $95,000. That's a pretty significant piece of equipment that I did not see a corresponding policy for. So yeah, I would recommend getting a coverage on that boat. As well, say there's a significant claim. Maybe you have a bad car accident and there are injuries on both sides and it exceeds the limits of your current policy. An umbrella policy covers claims above and beyond what your current policies cover. If you've ever seen the commercial where he's holding the umbrella, so say you have someone drives their car into your house and causes all this damage. The umbrella policy, whether it's your car, whether it's your boat that will now be covered, whether it's your home, when you have claims that arise that exceed what that individual policy will cover, the umbrella policy picks up from there. So they take over from the maximum amount that your individual policy covers, and it will go up to $1 million or $2 million or $3 million. Given the sizable assets that you own, I think $2 million would be a minimum. So I have that on your list of items in addition as kind of immediate needs. And again, we're going to recap this later. Immediate needs, boat coverage, the umbrella policy in place. As well, I did not see on your policies any endorsements or an additional policy on the inverted Jenny stamp. And given the value of that collectible item, I think some specific insurance coverage on the collectible item would also be prudent. So I have those in our kind of task list or our action item list at the end. I looked at your health insurance, your Medicare coverage is in place, you've got your supplement, you've got your prescription plan, so that's all good. You are subject to the additional premium because your income level is so high, and I don't see that changing in the foreseeable future, even after your, I'm going to check my sheet here, even after your payments stop on the installment sale in 7 years, your investment income, I think, will still keep you above that threshold. Of course, the threshold increases each year, but you're pretty well above it. So I think you are going to be subject to that additional amount on your premium for the foreseeable future. With your Medicare coverage, remember open enrollment is every year, October through December, usually around the beginning of October to the beginning of December. Particularly the Part D plan coverages change. The prescriptions that are in formulary or that are considered specialty, they can change every year. So I recommend every year, October to December, just going through all the coverage options again, making sure the plan you have is the best fit. And if it's not, if something has changed within your plan, or maybe you started a new medication, or there's a new diagnosis that you need different care than you did before, it's a good idea just to update that, relook at every single year during that open enrollment window. And you had asked about long-term care. So you both currently have life insurance policies. You have universal life insurance policies. The face value on those, let me come back here. So John, you have a life policy on yourself with Mary as the beneficiary and the kids split individually as the contingents of $2 million. That costs you $28,000 a year. And the cash value in that is $900, almost $1 million. And then Mary, you have a policy on yourself with John as the beneficiary and the kids split equally of $400,000 death benefit. And your cash value is now $185,000. Given the size of your estate, and we'll talk about estate taxes later. Given the size of your estate, I like having a death benefit available for the kids so that when you both pass on and there are estate taxes to be paid, life insurance is a really efficient means of getting a large amount of cash to your kids to pay the fees and the expenses and the taxes associated with settling an estate. So I like having a death benefit available. I don't know that you need the death benefit for each other because you have so many assets saved and you're paying a significant amount of premium. Between the two of you, you're paying $33,000 a year for these policies. Long-term care, if one of you would need long-term care, could have a significant impact on your finances. The average cost of long-term care now is about $9,000 a month, and you would have to spend down your assets. Your assets would go fairly quickly. When I work with couples that are kind of on the fence of long-term care, I look at $1 million as being the minimum net worth that you would need to self-insure for long-term care. So for a couple, I would say $2 million. You meet that requirement. However, you already have a significant amount of cash value in life insurance policies. And when I look at life insurance or an insurance policy, I put it to a 3-part test. What happens? I spend all this money on this insurance policy. What happens if I decide I don't want it anymore? The live, die, or quit test. What happens if I quit the policy? Do I get money back? All the money that I've spent on it, will I get anything back from it? For instance, your auto property or property insurance. I mean, you don't have any options. You have to have it, but you put all that money into it, you never use it, and then you cancel the policy. You don't get any money back on it. A term life policy, you pay into it for 20 years. You don't die within the 20 years. You don't get any money back. And now you don't have a death benefit. So if I quit this policy, do I get any money back? If I don't need to use the policy and I've paid all this money, do I get any money back? And if I die, do I get any money back? So with a true long-term care policy, you can pay all these premiums into it. And then if you decide you don't want to pay those premiums anymore, or what I see happen actually fairly often is that one spouse passes away while everything is in transition. Some bills get missed because the surviving spouse is trying to deal with everything that goes along with losing someone that they spent their life with, plus all the financial and legal hassle that goes along with it. What I see happen more often than not is that premiums get missed because the payments don't get made and those policies lapse. So I pay into this long-term care policy. If I decide I don't want it, I don't get anything back. If I don't ever need it, hopefully you don't have to go to a nursing home. That would be the preference. If I don't ever actually need to use the long-term care, I don't get anything out of it. And if I die without using it, I don't get anything out of it. So there are hybrid policies that combine long-term care coverage and life insurance coverage so that if you need long-term care, the long-term care policy takes over and it pays your monthly rate while you're in the nursing home. And this is a rate that we decide on, and there's underwriting involved to determine that you're healthy enough to qualify for the policy. But if you don't need long-term care, then it also acts as life insurance so that if you pass away, then there's a death benefit. Since you each have two long-term or two life insurance policies that have a really large amount of cash value in them between the two of you, what your insurance agent can do, and I feel if you give me permission, I'm happy to talk to your insurance agent about all of these recommendations. What they can do is they can do a like-kind exchange. So they're exchanging one policy for another policy of another similar policy. Long-term care and life insurance qualify as a like-kind exchange. So your insurance agent can take the cash value that's built up in the policies that you have now and use that to replace your current universal life policies with a hybrid life long-term care policy. And this would be tax-free because they're taking one like product and they're exchanging it for another. It's called a 1035 exchange. I would recommend looking at that with your insurance agent. And again, I'm happy to talk directly with him and go through all of this as well. That being said, I mentioned earlier, I like having some kind of death benefit available for the kids after you're both gone to settle the estate fees and expenses and taxes. And life insurance is the most efficient way to get that to them. There are also life insurance policies called survivorship universal life or second to die policies. So these policies, it's one policy and it insures both of you as a couple. They're also easier to get because they look at the health and the life expectancy of the healthier spouse. So if one spouse has health conditions and normally can't get insurance on their own, they can still be covered under the policy because the insurance company is only worried about the one that lives the longest, basically, which is probably the healthier spouse. So the survivorship policy would be one policy for the both of you. The first of you passes away, it stays as is. The second of you passes away, the death benefit goes to the kids. I would recommend that because you're only paying the premium on one policy versus carrying premium on each of you individually. When the purpose of that death benefit is to get cash in the kids' hands to help pay estate taxes. So with your insurance agent, again, we're going to recap all this later. I would look at using the cash you have in your two current policies, your individual policies, to get that hybrid policy so that you can use it for long-term care. Or if you preferably don't need long-term care, then you have the death benefit. But also that one additional policy, just enough to cover estate taxes. The survivorship or second to die policy. That would be a new policy. Any questions on the insurance planning? Yeah, so you had talked about gifting your life insurance policy. So I should have mentioned this in the 529 plans as well. When you leave assets to someone that's not a direct descendant, and your direct descendant, meaning your kids, are all still alive, the IRS considers that a generation skip. The IRS is okay with you leaving gifts to your kids, but if you're skipping over your kids to leave gifts to your grandkids, then they want additional taxes on that. So with the 529 plan, that was part of the reason that I kept you within that $19,000 per year per person threshold, was so that if you go above that threshold, then you're subject to generation skipping tax. So your life insurance has almost $1 million in it. If you leave that to your kids, or if you put that if you gift that to your kids, even splitting it up between them, even if you use the crummy notes, which basically says that they have access to a percentage of it each year, which for IRS reasons is preferable, you will still have a taxable gift in there that would also be subject to the generation skipping because it's going to be more than $19,000 per kid per each of you, even using your gift splitting. If you did that, you would have to file that same form that you would for doing the 529 plans. Again, I would prefer to see you use those universal life policies to meet one of the goals you mentioned, which was long-term care, and use those universal life policies to give you a better, more comprehensive policy that would help you regardless if you need long-term care or not. if you did the true long-term care policy, it is not my preference. If you did the true long-term care policy, the IRS does give some tax benefit to the premium that you put in, where you can take that as a deduction. It is, in my opinion, it's fairly minimal. John, you would be able to deduct $6,000 of your long-term care premiums per year. Mary, you would be able to deduct $4,800. Again, I think using the cash value in universal life would be preferable. But alternatively, if you would like true long-term care insurance, or if the 1035 exchange doesn't pan out, then with your insurance agent, we look at just true direct long-term care, and you do get some tax deduction benefits on that. Okay, so moving on to the investment piece. So we're here in the summary of investment planning. We put together what's called an investment policy statement. It basically reiterates our goals, our timelines, and our constraints. And I mentioned some of this earlier. You've got an above average willingness to take risk. You have an above average ability to take risk because of your net worth and your assets to liabilities ratios. We have 2 time horizons. We have the time horizon where you're both alive, that for me, I'm projecting out to age 100, so about 30 years. And then the second stage is dispersing your assets to your children and your grandchildren. Only major purchase coming up is that $40,000 for a new car. And taxes are kind of the biggest area of concern because so much of your income need, almost half of your income need, is going to taxes. And you're in the highest marginal tax bracket. So the one unique circumstance is that the tobacco-related stocks we want to avoid because of your parents. So when I look at your current stock portfolio, so you have 4 separate portfolios. You have 2 that are being taxed on gains and sales every year. Those are your stock and your mutual fund portfolio. And then you have 2 that are growing tax deferred. All of the money you put into them, you never paid tax on. And when you take that money out, it's going to be completely taxable as income. That's John's 401k and Mary's 403b. So when I look at those 4 accounts, you've got 3.8 million in the stock of the mutual fund that is kicking off taxes every year. And you've got 1.6 million in the 2 retirement accounts that are not kicking off taxes. They're growing tax deferred, but we're also building this big pile of taxable money. Overall, I don't feel that they are well diversified, and they're underperforming a little bit. We do a few scenarios. One ratio that we look at is a Sharpe ratio. So it measures the amount of risk taken in a portfolio to the amount of reward received, so the growth received in a portfolio. And we want to see a good risk versus return ratio on that. So we take your portfolio and we run that ratio on it, and then we take the average performance of the market. And what we want to see, preferably, is that your portfolio outperforms the market. Otherwise, you just go buy an S&P 500 index fund and hold it, and you would have that Sharpe ratio. So when I look at the risk in your stock portfolio, it's just, we look at a number called a beta that measures the volatility of your portfolio. You're just over 1, and our benchmark is 1, which says for your above average risk tolerance, we would want to see it a little bit above 1. I'm going to look at my notes here. When I look at your portfolios, I'm going to start with the stock portfolio. There are 4 stocks in the stock portfolio, A, B, C, and D. A has some significant losses to it. You started at $225,000, you put into it, and it's only worth $7,000 today. The other 3 stocks have some growth to them. D has probably the least growth in it. First, I would like to see, with almost $1 million in that, I would like to see more than 4 stocks in that. For $1 million, I would like to see that $1 million split up about 10 ways. So about 10 stocks, or $100,000 per stock would be kind of the goal to get some good diversification in there. because anything that we do, any sale that we make in that account where there's been a gain is going to subject you to capital gains taxes of about 20%. We're trying to reduce taxes. I would like to say, let's do some tax loss harvesting and maybe take a longer term approach to transitioning in and out of these stocks. But because you have over $200,000 of loss on stock A, we can count against gains that we sell out of stocks that have appreciated. So I would say let's close the positions on A and some of B. The reason that I chose B is because it's a pretty conservative stock. Its volatility measure, its beta is less than 1, and we want to see you taking a little more risk, because when you take a little more risk, which you're fully capable of doing, you get greater rewards and greater returns, hopefully. That's the plan. So we can use that proceeds to purchase shares of 2 more stocks. And if you have stocks in mind, please let me know. I'm happy to look at them and give them a scan. Otherwise, this is what I do is I'll put together the portfolio for you to give you a diversified 10 stock portfolio for these funds. In addition, we had discussed taking the $800,000 from the sale of your business plus the $47,000 a month that you have coming in and investing it in your after-tax portfolio, so the stock portfolio or the mutual fund portfolio. As we have more funds coming into it, we will also use those new funds coming in to purchase new stocks, additional stocks. And that gives us 2 advantages. We've got one, we're purchasing new stocks, so we're adding diversification to build up to the 10 stocks we want to get to. We're also using dollar cost averaging, which is proven across historical records. When you put in an amount of money every month into an account, whether you're buying high or you're buying low, over time, you will outperform picking one date and putting all your funds in on that one date. So we get the benefit of dollar cost averaging by just directing the installment sale proceeds into that stock account each month. The mutual fund portfolio, you had mentioned that you would prefer to not have tobacco-related stocks. And in your mutual fund portfolio, your balanced, your growth, your bond, even your international funds, they are comprised of underlying securities, which could be stocks, they could be options, or they could be bonds. There's a good chance that some of those underlying securities are tobacco companies. So I would recommend taking that mutual fund portfolio and exchanging those mutual funds for exchange traded funds. While we do that, let's better match the funds that we choose to your risk tolerance and tax preference. So mutual funds are comprised of underlying securities, which is stocks or bonds typically. And the mutual fund manager, the big wig that's somewhere in an office saying, I want these underlying securities in this mutual fund. They are consistently monitoring that fund and they're buying and selling in and out of the underlying securities. So say they have 100 stocks in this fund and they say, well, these 5 are underperforming. I'm going to replace them with this new 5 that I think are a better fit. As they do that, you are taxed on the gains from the sale of the underlying securities. Mutual funds have what's called a turnover ratio. And say they have a 33% turnover ratio. That means that each year that mutual fund manager is exchanging 33% of the underlying securities. And that's kicking off taxes for you while they do that. Exchange traded funds they're built the same as a mutual fund. So they're comprised of underlying securities, stocks, and bonds. However, as the fund manager buys and sells in and out of the underlying securities, there is no tax being kicked off. So that provides a really good tax benefit to you because so much of your income that you're being taxed on is from your investment taxes. And because you're paying a higher investment tax because you have that additional 3.9% net investment income tax because of your net income being so high. So I would say let's take this mutual fund portfolio Let's take the balanced and the growth in the international fund, scan them for tobacco related companies, and let's exchange them, assuming they contain tobacco related companies, which I feel like they are. Let's find an appropriate exchange traded fund that matches the risk tolerance that we want, but also does not include tobacco related companies. And there are funds out there for anything under the sky. So there will be exchange traded funds that are specifically do not include tobacco related companies. So that once we get those in the account, that will minimize some of the tax, because now you're not going to be taxed on the turnover. So as long as you're holding them in there, they're not going to kick off the taxes except for whatever interest or dividends are kicked off. In addition, you've got a bond mutual fund in there that I would like to see a bond exchange traded fund replace it. But if we purchase a municipal bond exchange traded fund, that will give you some additional tax deduction, because you can deduct some of the gains from the municipal bonds. So that will give you a greater tax benefit. So that stock portfolio, we're going to expand to 10 stocks to get better diversification. Use some tax loss harvesting as we go through that, meaning we're going to take some of the losses from stock A to offset the gains we make selling others. And then as you contribute the $800,000 in the monthly income, we're going to use that to purchase new stocks to expand that out to 10 stocks. So then you're going to keep stock C and D, and we're going to buy 8 more new stocks. In your mutual fund portfolio, we're just going to exchange that out for exchange traded funds that don't contain underlying securities that are tobacco related. And we're going to exchange out the bond fund for municipal exchange traded fund that will give you more tax benefits. So I think that will help minimize, or at least decrease, some of the taxes that you're seeing now by getting that mutual fund portfolio especially set up in a much more tax efficient manner. Now for your retirement accounts, Mary, you have your 403B account set up in a 2025 fund. So the target date funds, they're called a fund of funds. So the mutual funds that I mentioned before that contain underlying securities like stocks and bonds, the target date funds contain underlying mutual funds. So your 2025 fund is going to have probably a high percentage of bond funds that contain underlying bonds. And then it's going to have a lower percentage, like maybe 80% even bonds, and 20% balanced funds that contain underlying stocks. Because you retired last year, you were put in a 2025 fund, because while you're working, they say, what's your retirement date? And you say, oh, I want to retire in 2024 or 2025. They put you in the 2025 fund because it's a set it and forget it. So 20 years ago, maybe you bought, well, it might not have been around 20 years ago, but 10 years ago, maybe you bought into this fund. And as your timeline towards retirement gets closer, the fund adjusts to go more conservative. So that when you retire, you can draw money from it, because now you're retired and they're assuming you're going to draw income from it. And they want it to be more conservative. But you're not drawing money from this fund. So instead of using your retirement date as the horizon, I would say you're not going to touch the money in that account except for taking out required minimum distributions when you're 73. I would say let's use your kids' time horizon, because essentially the money is going to be left behind to your kids and they have a much longer time horizon. So I would say let's take that 2025 fund and replace it with maybe a 2040 or even a 2050 target date fund, because we know you're not going to access the money. Let's let it grow longer instead of being tied up so conservatively. John, and I did notice, Mary, on your 403B account, you have the beneficiary as your estate. And I would like to see, let's name an actual person beneficiary on that. And we'll talk about that in a minute. John, your 401k portfolio is a little bit less aggressive than your risk tolerance would suggest. And again, because you're not planning to draw from this 401k portfolio, the risk tolerance we're really using is the risk tolerance of who is going to be left be left to, and in this case, charities. So, John, you're 71 now. You have to start taking required minimum distributions out when you're 73. But what I would recommend is that if we take those RMDs, required minimum distributions, out now, this account's going to charity anyway. So let's start getting some tax benefits out of giving the funds to the charities while you're still alive. Since you're over 70 and a half, you can actually direct money from your IRA directly to a charity, a 501c3 charity. It's a qualified charitable deduction, and it's an above the line deduction. So like when you itemize on your taxes, say you're deducting your property income tax or the interest paid on a mortgage, let's use that one. That's just part of itemized deductions. And if you don't go over the $29,000 standard deduction for the year, you don't get any credit for it. But when you give money directly from the IRA to the charity as a qualified charitable distribution or a QCD, that's an above the line. So you have your taxable amount, and then you take out the amount you gave to charity, and then you could have your itemized deductions on top of it, or you can have your standard deduction on top of it. Given that taxes are a big area of concern for us, I think that account's going to charity anyway. You're past the age of 70 and a half, so you can give qualified charitable distributions. So let's start giving them this year and take advantage of that tax deduction, the above the line tax deduction. Also, because we're giving the funds to charity, I feel like you could go a little more aggressive. You're comfortable with taking on more risk. Your large cap blend is a good balanced blend in your 401k account, but I think we could diversify it a little bit and throw in some small and some mid caps as well and allow more growth over time. And it just will give more funds to the charity, basically. So I would like, if you accept those recommendations for diversifying the stock portfolio and getting up to 10 stocks in it, for taking tobacco-related funds out of the mutual fund portfolio and making that an exchange-traded fund portfolio that includes municipal bonds, taking John's 401k account and greater diversifying that so that we can transfer funds from the 401k to an IRA that we set up for him, and then the IRA to the charity. Unfortunately, they can't go straight from the 401k to the charity, so we have to add that extra step in there, but it's not a big deal. And also taking Mary's 403b account and pushing out the timeline on it to get greater growth potential over time, since we also know that's not going to be used for income. So if you accept those recommendations, we'll put together an asset allocation strategy that maximizes your return, maximizes tax efficiency, it's more diversified, and it also matches your risk tolerance level and your preference not to include tobacco-related funds. Does that sound good? Okay, I'm just checking my notes here. That looks good. Okay, taxes. Now we get into the fun part. Okay, so tax planning. Moving on here. Summary of your tax planning. When I start my process, for me, it's a very manual process. It's me in an Excel spreadsheet in a financial calculator, and I put in every day or every year from now until you're 100 years old. And I put in every stream of income that you have coming in, every insurance policy that you have, and every asset that you've saved. And I put a timeline and a purpose to those funds. I just realized I missed your annuity when we talked about the insurance tab, as I was picturing your assets in my head. So you have this annuity. I'm going to change gears here and go back to the annuity really quickly because it does have some tax implications. So the annuity that you purchased, you bought with after-tax funds. So that means you put in, at the time, $30,000 of after-tax funds, money that had already been taxed. When you purchase an annuity, it's an insurance contract. So that $30,000, you purchase this insurance contract, and it gives you some growth, and it's kind of a safer growth because it's not in the market. It will give you growth, but also if the market is down, you may just sit on zero or you may have a minimum floor. All of the growth is tax deferred though. So unlike your stock and your mutual fund account where it's growing and it's paying dividends and interest, everything held within this annuity grows tax deferred, more similar to your retirement accounts. When you go to take funds out of it, it's taxed differently than either of those. So annuities are taxed last in, first out, which means last in is all the growth that it's earned over the years. You took out $5,000 since you've had it, so you've got $25,000 of basis that you've actually put into this contract. It's worth $102,000. So you've got $77,000 of growth. So as you take money out of that annuity, that $77,000 is going to be taxed until you get down to the last $25,000. Now you had a question on the tax treatment if you annuitize. So if you just turn that annuity into an income stream. And if we did that, let me find my notes on it really quickly. If we did that, then they use a ratio. Similar to when I did the homeowners calculation of the 80%, they use a ratio similar to that. So they take the ratio of the money you've put in to the ratio of the growth. And then they say, you have this percent of what's in the annuity contract as your basis. So for if you annuitize and you're taking monthly payments of $600, they say this percent of every payment is going to be a return of basis that's not taxable. This percent is going to be growth that you're taking out that is taxable. So if you took $600 a month out, $83 of that they're considering return of basis and it's not taxable. So $517 would be taxable every month. You don't need the income. Once you annuitize an annuity, it stops growing. So that $102,000, if you say, okay, I'm going to turn on this $600 a month, all growth stops at that point. And now you just have your $600 a month. Annuities, in my opinion, are good for conservative-minded people that just want to know they have the guaranteed income. Regardless of what the market does, they know this amount is coming in every month for the rest of their life. They are good for people that didn't quite save enough for retirement because you can maximize you can maximize how much you can take out of an annuity versus how much you put in. In your scenario, we're trying to minimize taxable income as much as possible. And as long as it sits in the income, in the annuity as is, it continues to grow and it continues to grow tax deferred. If you leave that annuity to your kids, they have to take it out and it will be taxable to them as well. I would recommend possibly looking at the annuity beneficiary as a charity because the charities would be able to take it with tax-free. So the annuity is something that we can look at. I don't think it's a priority for now. I would recommend just keeping the funds in the annuity because we just don't want any more taxable income, especially if you don't need the income from it. Okay, so back to the tax planning. I skipped over retirement planning. You'll see there's a portion here for retirement planning because it is normally part of a comprehensive financial plan. You're in the retirement phase of your life. So everything that I would normally discuss in the retirement planning section, we've already discussed in the tax planning section, in the cash flow, in the investment section. So I just didn't want to be redundant and include it there. Okay, so tax planning. I looked at RMD calculations and I looked at the installment sale calculations. And the reason that I'm looking at RMD calculations is because they start pretty quickly for John in 2 years. And when I look at the required minimum distributions, John, you would, in 2 years, when you have to start pulling money out of your 401k, your RMDs are going to be around $44,000 a year. Mary's years were going to be closer in the 20,000s. And again, this is, projections. What I look at when I look at that is to see if it's going to impact your adjusted gross income, if it's going to push you into higher tax thresholds. Again, you are not using the funds that you have to take out for income because your income needs are met with what you have coming in. So John, I would recommend those qualified charitable distributions, the QCDs. Take the above the line deduction. The money's going to go to charity anyway. Mary, there are a couple things that we can do with your 403B if we decide. the 20,000 or so a year in RMDs, I don't think it's that much of it doesn't affect your income or your tax thresholds. I looked at, it doesn't make a difference in your Medicare surcharge. It doesn't make a difference in your income tax threshold. However, whatever's left in that 403B, when it gets left behind, if it goes to your kids have to take it out within 10 years. So then it's taxable income to them. What we can do about that in the meantime is over time, take a little bit of it each year, open up a Roth account for you, convert some to Roth. I would say let's do it over the next 7 years while you're already in high tax brackets, because you're already maximized on taxes. Over the next 7 years, we can convert a little bit to Roth each year. Otherwise, we can leave it sit as is, take those RMDs out, and your kids get it, just understanding that split between the two kids, they have to pay income tax and take it out within 10 years. Either way for Mary's, I think works. For John, I really recommend the qualified charitable distributions. I also looked at, because you were really concerned with how your installment sale would be taxed. So you've got the down payment of $800,000. You had a tax basis in the company of $900,000 that you've put in of your own money to the company. Again, there's a calculation that determines kind of your percentage of basis. So you had a $900,000 tax basis. So $900,000 of the $4 million you sold it for is a return of basis. That's not taxable. You had an $800,000 down payment. So they take the portion that they consider return of basis out of your sale price. So 900,000 divided by 4 million. They take that, and that's your ratio basically. And they multiply that ratio by the 800,000 down payment. So out of that $800,000 down payment, they're considering the percentage of that 800,000 that was your actual basis that's already been taxed was 180,000, which means 800,000, take out the 180,000 that's not taxable, 620,000 of that down payment is taxable. Now they take that same ratio and they apply it to the monthly payments. So your monthly payments are 47,000. They're going to consider your return of basis on that about 6,700 out of each 47,000, because they're going to take out some interest income from it. So your realized long-term gains on each payment are going to be 23,000 taxable each month. You had also mentioned that you were considering selling a piece of machinery and you were wondering how that would be taxed. If you sold that piece of machinery, you had already taken some accumulated depreciation on it. The machinery you bought for 100,000, you've already depreciated it down. You depreciated it down to $12,390 value at the time of the sale, and you sold it for $35,000. So because you had already depreciated it down to less than you sold it for, you are going to recognize some gain on that sale. And it would be considered Section 1245 gain of $22,000. It's reported on a Form 4797 that goes along with the sale of your business property. Again, your CPA will know how to handle all that within your business tax return. And that would be something I would discuss with the CPA. The only thing that doesn't apply to the sale of machinery, I had mentioned you're subject to that net investment income tax on the capital gains in your stock and mutual fund portfolios. The machinery, yes, it's considered capital gains when you sell it, but it is not subject to that additional 3.9%, which is good because it's a sale of property, or because it's non-passive. It's considered an active property in the business. You had also thought about what would happen if you sold your inverted Jenny stamp. So, and these are just kind of hypothetical assumptions so you would know what you're looking at. So if you sold that Jenny stamp in 10 years, it's worth $2.6 million. You're going to have to pay a commission to the sales agent. So let's say the commission's 15%, and so your adjusted sale price after you take the commission out of it is $2.2 million. Your cost basis in the stamp is the amount that it was worth on the day that you inherited it. So your cost basis is $825,000 because that was the fair market value of the stamp the day that you inherited it. when we take the sale price minus the commission minus your cost basis, that puts you at a gain of $1,385,000 that you're actually taxed on. Collectibles have their own tax bracket. The tax bracket for collectibles is 28%. So assuming all of those things above and your actual gain on it is almost $1.4 million, you would owe just under $390,000 in federal tax liability. When I looked at your deductions, because your income taxes are very high, but unfortunately there are limits on what you can deduct for what you pay in state and property taxes. So because you're already beyond those limits, your itemized deductions, so those taxes on your homes, your state income taxes, the interest that you pay on the vacation home mortgage, and your charitable donations, you're actually still under the standardized deduction amount. You can only claim $25,500, which is again why I think the qualified charitable distributions might be a good idea, because you can claim those on top of your standard deduction, since your itemized deductions don't exceed the standard deduction. Okay. Tax planning, I had already talked about the tax advantages of exchanging the mutual fund for the exchange traded fund portfolio, so I'm not going to go back over that. If we get them into exchange traded funds, then they sit there and you don't have to pay tax on all the turnover inside the funds. We talked about the qualified charitable distributions. Mary, you have options. We can do some Roth conversions on yours, or you can just take your required minimum distributions when you turn 73. Either way, I think to me it's 6 of one, half dozen of the other. It really depends on just your personal preference on how you want it to be passed behind to the kids. All right, so let me check my notes here. Mary, I'm sorry to hear that your mom had passed away this past year. You had asked about the IRA that you inherited from her. So IRAs are inherited a little bit differently. When a non-spouse beneficiary inherits an IRA, so you inherited your mom's IRA, you have 10 years to take those funds out. You don't have to do it equally over 10 years, but you have to have all the funds depleted by the end of the 10th year after the date of her death. And it's all going to be taxable to you. But your mom had some contributions in her IRA that she had already paid tax on. So the fair market value on the day that your mom passed away was $200,000. $20,000 of that she had already paid taxes on. So the federal estate taxes paid on that IRA were $80,000. That means $100,000 of the $200,000 has already been taxed. When you draw funds out of that, they're going to take the amount that was already taxed, the $20,000. They're going to divide it by the value on the date that you want to take the distribution. So say it's grown a little bit and it's now $202,000. And they're going to say, okay, $20,000 divided by $202,000 is 9.9%. We'll say 10% to make it easy. The entire amount of the IRA was in the estate taxes paid, though, which means you received the funds, what's called in respect of a decedent. Estate taxes were already paid. So they give you credit for the amount of the estate taxes that were already paid. The IRS says this dollar in this IRA has already been taxed. Because there were $80,000 of estate taxes already paid, the first $80,000 you take out of that IRA will not be taxed. So if you want to take a $50,000 distribution, that would not be taxed as income to you, and you could do that. All right, let's move on to the estate tab. So I've prepared kind of a balance sheet that lists the assets that would be included in your estate. And then I've also gone through to see which assets will go through probate. When the first of you passes away and the surviving spouse is left behind, anything that's listed in joint names, anything that's listed as that has a beneficiary listed, anything that is listed as like a joint tenant or a tenancy by entirety, or that has a transfer or payable on death designation on it, those will just go to the person it's left to, and it will not go through probate. And when a spouse is the person that is left to, there's an unlimited marital deduction for estate taxes. So the spouse gets whatever comes to them with an unlimited marital deduction. When you both pass away and it goes to your kids, that's when we don't get the advantage of that unlimited marital deduction, and there will most likely be estate taxes due when your kids inherit the estate from both of you, which is why I recommended that survivorship life policy to help just give them some immediate liquid funds to help pay the fees associated with that. However, there are some things that we can do to set up your estate for the both of you to inherit the surviving spouse when the first of you passes away, and for your kids. Mary, one thing I noticed is that your life insurance policy is payable to your estate. As I mentioned, anything left to a specific person does not go through probate. But because your beneficiary is your estate, your life insurance proceeds would have to go through probate. So I would recommend, you could change the beneficiary right now just to be safe. But definitely, if you do end up exchanging that life policy for the long-term care hybrid policy, I would update your beneficiaries to be John first and then the kids, or you can just leave them to the kids. It's up to you. If you list John first and he doesn't want the funds, he can decline the funds and they'll just go straight to the kids. You can do it that way. That gives you, more options just in case. Upon both of your deaths, I think you would exceed state tax thresholds in New Jersey. And I think there are some things we can do, because probate, when assets go through probate, there's a fee. 3 to 5% of the amount of the estate is typically what probate fees are. So as much as we can get set up to avoid probate, I think that's in your best interest. So to minimize your probate assets, I'm looking at John's CDs that are listed in his name only. The mutual fund portfolio is listed only in John's name. You can request from the bank that has the CDs and from the custodian of your mutual fund portfolio, you can request a transfer on designation or a payable on, or transfer on death or a payable on death designation. So they'll send you this form. It's basically like listing a beneficiary. So you write on this form who you want these assets to go to when you pass away. You sign it, you send it in, they have it on file. So when you pass away, it's essentially leaving a beneficiary. So your CDs, if you say, I want these CDs to transfer on my death or to be payable on my death to Mary, it will go straight to Mary. Same with your mutual fund portfolio. As long as you have that designation on there, those assets won't go through probate. But if you died today, those assets would be stuck going through probate because they're only in your name and there's not a designation set up for them. So they would go through your estate, they would go through probate, and then probate would say, okay, the estate goes to Mary, but you would have to pay the additional fees on those. I also look at assets, physical assets, and how they're titled. So the vacation home is titled only in John's name. The Chevy SUV is titled in John's name. The boat is titled in John's name. Looking at if Mary has a vehicle on here. Okay. Those assets, again, because they're only titled in John's name, if John died today, they're going to have to go through probate, and then probate's going to send them through the estate process. So I would say just retitle those assets. You can do tenancy by entirety for married couples so that when the first of you passes away, the surviving spouse just inherits the property as is, the entire property. That way you avoid probate. I would suggest meeting with an estate planning attorney. That's kind of one of the immediate priorities that we have. There are 2 types of trusts that you can set up that will help you remove some assets from your estate. So we've talked about getting as much out of the probate estate as we can. Now let's talk about getting assets out of the actual estate, because when the both of you pass away, your kids are going to be subject to paying the taxes on the estate that's left behind, because they don't have the benefit of the marital deduction that you do when the first of you passes away. Your estate planning attorney can help with this. And I'm happy if you give permission. I'm happy to speak with them. But if you set up a bypass trust, that allows the use of both of your estate tax thresholds, because you both get that marital deduction. It allows you to both use your estate tax threshold combined. And an estate equalization trust allows us to remove some selected assets. For instance, the new second to die life insurance policy might want to be held by the trust, because then it's removed from the estate and it pays the death benefit to the trust, which then pays the death benefit to the kids to pay the estate taxes. You might be able to speak with the attorney about how to set up that inverted Jenny stamp to get that inside of a trust as well, because it's one stamp and you have 2 kids and you have 3 grandkids. That might be a good asset because of its sizable value to get set up inside of a trust. And if we can get that also removed from the estate, that's a big help, because that stamp is worth $1.5 million. And again, you're going to decrease your taxable estate by just starting those donations, those qualified charitable donations now. And the more you get donated while you're alive, the less that's part of your estate later on. So I would set up an appointment with your estate planning attorney as soon as you can. So to recap, this is kind of the meat of it, is this action plan. Visit with an estate planning attorney as soon as possible. And I have it listed here. You're going to want to set up your estate planning documents. You might want those 2 types of trusts, or your estate planning attorney might have a better idea. And you also want to plan for each of your incapacities. So if one of you is in the hospital and can't make decisions, make sure you've got things set up for the surviving spouse or for your kids to be able to make decisions if needed, if you can't make your own decisions. That's the first goal, I think. And an estate planning attorney can help you with implementing those. Typically, that runs around $10,000 for a complex trust such as this. Second, the insurance agent that referred you to me, I'd like you to set up an appointment with them. And again, I'm happy to talk to them. You've got a couple things to do insurance-wise. Increase the coverage on your primary residence. Get boat coverage. Get an umbrella coverage. Look at that survivorship, second to die life policy. And look at possibly exchanging those 2 life policies that you currently have individually for 2 long-term care hybrid policies. If you do the survivorship life policy and we want it to be part of the trust, which is important, the trust has to be set up prior to get the tax benefits. The trust has to be in place first, because the life insurance policy has to be bought in the name of the trust. So we want the trust first, then the life policy. So I would say the estate planning attorney as soon as you can, but definitely within the next 2 to 4 weeks. And then the insurance, I would get that coverage in place as soon as you can, but the fine tuning really can be done in the next 30 to 60 days. The source of funds for that, increasing the deductibles, you can help offset some of the additional premium. You're still going to be out of pocket for additional premium because we're just buying more policies. The survivorship policy, I would estimate it would run, it depends on your health, but I would estimate it would run around $20,000 a year if we do $1 million survivorship policy. When I look at that survivorship policy, you have enough investment income coming in now from the sale of the business to basically take the interest earned off the top of the sale of that business and use it to fund this survivorship policy. So we only need a 3% return on $800,000 to kick off $20,000 a year of interest. You could also use the interest earned from your bank CDs, as long as the $600,000 in the bank. Remember, we want some of that in shorter duration CDs for emergency fund, but some of that could also be earmarked to pay these premiums. You only need to get a 3.5% interest rate on those CDs. So as long as the interest rates are above 3.5%, we could also use that interest to pay this survivorship life policy. And identify the charitable organizations that you want to support if you haven't already with those qualified charitable donations. Those donations can be made anytime throughout the year. It doesn't matter. So just get that list together. So they will have their own process for doing the qualified charitable donation and the giving. So once you identify those, I'll do the research and we'll set up an IRA for you so we can take the funds from your 401k to the IRA, tax-free exchange, transfer from the 401k to the IRA, and then from the IRA to your charity. And then finally, for the charitable giving, I would recommend a minimum of $44,000 a year. You can donate up to $66,000 a year, and basically have a 30-year time frame to deplete that 401k if you want to. But I would say let's do $44,000 to $50,000 a year. And finally, the asset allocation. So we'll go through that. Replace the mutual funds, take out the tobacco-related securities, replace the bond fund, get some exchange-traded funds and municipal bonds in there, diversify the stock portfolio, use dollar cost averaging to invest the installment sale proceeds, and to purchase more stocks for greater diversification. And then we'll update the allocations on your 401k and your 403b, and there's no tax implications on that. So attached to this, we kind of went through it as I was going through it here, but you've got your statement of financial position, your statement of cash flow. Those numbers are as of December 31st of this year. Insurance scenarios that I used, your property ownership spreadsheet and your state tax calculations, and then your retirement income and your RMD calculations. I recommend taking all of this because it's a good rundown of your assets, and just throw it in your safe or in your whatever folder you have for if you pass away, the person left behind has to go to, because now you've got all of your assets basically listed in one place. So it's helpful for that. And do you have any questions? All right. Well, I'm sorry this meeting went a little bit long. That was a lot to go over. Again, we're going to start with those first 4 things. Set up the appointment with your estate planning attorney and set up the appointment with the CPA. The investment piece we'll take care of. And I think that's all we have. It was really nice to see you guys again. All right. Have a good one. Bye.